Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 130. My name is Bryan Anderson, founder and creator of Talk.Com. Excited to come to you again from Tucson, Arizona. I moved to a new spot, quite like the backdrop. It's absolutely gorgeous here, right on the edge of Saguaro National Park. I appreciate the support I receive from everyone, the well wishes, the positive energy that comes my way that I try to spread to everybody else. Thank you so much for supporting my business. I do my best to help people out. We got a lot of happy people across the country. And number one thing is to get what works best for you and help you understand the retirement landscape. Please like, subscribe, or comment on any of your favorite podcast platforms or on YouTube. Share it with your friends, people that it might help. If you want to make an appointment, top right corner of any page on Annuity, straighttalk.com. I'm going to talk about last week. I did a little bit on the guaranteed index annuity rates. They're not all like that. And I'm going back, and you guys will see it if you're looking at the video camera on this, or on the video, that this was written in March of 2021, and it's index annuity rate adjustments. Now, I jumped the gun last week talking about specifically some index annuity rates that are guaranteed for the entire surrender term. People really like that. I could have done this first, but I just wanted to pop that out there because that's kind of the solution before the issue. Now we're doing the education. This is why everything happens. It seems like the requests for this kind of come and go over time. And lately I've been getting a lot of questions. So you guys are going to want to know the insurance companies do retain the right to make changes. This is all with the exception of what I talked about last week, which is a couple of specific products. There's only one contract that I know of where all the rates are guaranteed for the entire surrender term, but it comes with conditions. You got to stay in the index and all that stuff. A lot of people look at that and say, well, the insurance company's just going to screw me if I do that. And that's not at all what it is. And you guys have to, we're adults. We have to understand the concept behind it. But consumers justifiably will say, well, I feel like I'm getting less control. But I'm looking at this, and this newsletter is going to be updated for those of you that want to just go ahead and read it. Update, it's going to go to the top of the list. This is something that I can kind of keep pushing to the top just so people that are new can see it. A few years ago, I was talking to a client, and he already had a product, an indexed annuity. He'd had it for 2 years. And what you get in the financial services business, somebody's always going to come and try to grab the money, try to tell you made a bad decision. That's why education is so important. And the way that I take people through this is bulletproof, because you know exactly why you did it, and you can justify it years down the road. But this guy was talking to his friend of his that was in the banking world, and the guy said, oh, man, you got to worry about those things because they can just change the rates whenever they want. I could do a whole rant on the banking world. Those guys are not qualified to talk serious financial concepts. All they're doing is shucking loans to people. Anyway, whatever. But you got to worry about it. And it was funny because it was his anniversary of the contract. So you've owned it for 2 years. Look at this. Your rates are the same. So whatever scare tactic he said, I don't know what the banker thinks. Oh, yeah, you just buy CDs. But after 2 renewals, a person had the same rates and growth opportunity that he had when he got the contract. So this goes way back to the years of picking the right contracts, picking good companies. So I've been doing this long enough, and I was one of the most reluctant adopters of this strategy. I hated index annuities even when I started this website. I've talked about how I came into it. One client wanted to try it. We tried it. It worked. Everything was fine. Other people asked about it. Yeah, sure, go ahead. I love MIGAs. I love SPIAs. I love income riders. They're all perfect for a certain situation. And who knows? There are a lot of people that like the index annuities because they can do really well. I'm not trying to say that rates will never change. There's more to it, though, than the whim of the insurance company and just whatever they want to do. Cap and participation rates are based on 2 variables. Interest earnings on the company's bond portfolio give them money to buy an option on a market index. So the rates you're going to get, cap and participation, are based on interest rates and options pricing. That gives you your growth potential. No company knows what the cost of an option is 1 year from now or 5 years from now. If interest rates or the cost of the option change from year to year, you're more likely to see adjustments to rates. Now, in the case of last week, where you have a guaranteed cap for the whole period, the way they do it is by buying a block of options for 7 years based on today's rates. That's why if you leave the index, you can't get it back. Option prices change constantly from day to day, from minute to minute. You got to expect some variability in the rates over time, and it's quite likely for them to increase as well as decrease. Going to next week, because I'm going to show you guys a bunch of examples for this. Right now, I'm just going to explain the concept. So over time, there are several things that can change the rates, and everyone needs to understand why it is not such a bad deal and how it's really no different than just about every other investment. So basic math here. Let's say you have $100,000 in an index annuity. The company bought bonds that provided interest to buy market options. After a couple of years with decent growth, your account value is up to $110,000. It's 5% simple interest, whatever. And it's an example. So during that time, the insurance company had to buy another $10,000 worth of bonds to back the contract and produce interest earnings. Do you suppose that interest rates and option pricing was a little different each time new bonds were purchased? Perhaps that's a pretty reasonable explanation. New bonds mixed with old bonds will create a blended yield that is different from the single rate when the contract was purchased. If interest rates have dropped, then you might see a reduction in your cap and participation rates. If rates rise, then it might go the other way too. One thing I've learned since this was done is that certain companies will do it a little bit differently. Some companies use laddered pricing, laddered bond portfolios. Other companies use long-term projections, so they have some pretty solid consistency. So rate adjustments in an index annuity are no different than buying your own bonds or dividend-paying stocks. So if you're dollar cost averaging into a stock bond portfolio before you retire, every time you put a payment in, you buy 40% bonds, 60% stocks, your bond rate's going to be different. Nobody complains about that. It only happens when it's the annuity. You make money in an index annuity, the insurance company's buying more bonds, that rate's going to blend out over time. New money gets new rates with a bond, and that blends to a higher yield or lower yield than the starting rate than the very first bond you bought. It could be better or worse. Same with stocks. If you buy a dividend-paying stock, purchase price determines the value of dividends relative to the return on investment. If a stock price doubles, the dividend will effectively be half of what it was before. A 6% dividend, $6 on a $100 stock goes to 200. That dividend doesn't double, not usually. Now all of a sudden it's a 3% dividend. You're happy because you got a bigger balance. Are you bummed out because, oh, hey, the dividend's a smaller percentage? No, the same money. So when it relates to the annuities, nobody really goes back and understands and tries to get the concept and say, this is why it happens. There are also other ways the insurance company operates to mitigate the risk from the outset. So on the first day, the bonds backing an annuity haven't earned any interest yet, but you still get an option purchase for the first year. They pay a commission, and the bonds haven't earned any interest, but you still get the option. So the actuaries calculate that spans the term of the annuity and beyond. So surrender term, 5, 7, 10 years, plus they're annually renewable after that. They've got to project what they can do. And this is something the companies have gotten better at since index annuities have been used for the past 30 years. Company needs the ability to make adjustments if there are dramatic changes in the economic environment, i.e. interest rates or options pricing. Volatility in the market has a big effect on that. But it takes a much deeper level of understanding to accept that. It's guaranteed money. No other place in the financial services industry, nothing you can put your money gets the capital G guarantee. You read the newsletter, that guaranteed is capitalized for a reason. So if that's not enough, one last thing I can give you, there are literally a couple of contracts that offer cap and participation rates that are guaranteed not to change during the surrender period. I said that last week, whole podcast on it, talking about specific details. So that's something that existed back then, and I talked about it as well. I hope you guys understand how this works. One thing I'll say that's not in this newsletter, which will probably come out in the edit, is that it pays to work with companies. This is why I'm pretty stringent and I don't shop around to a whole lot of other companies. I tested the waters with a few of them. I got lucky in the beginning. I was cautious to move and expand out to other companies. I still am. There are good companies that do well. I need a material difference to change what I'm doing. One thing I'm going to talk about next week is I'm going to show you proof and show you why I did it. I'm going to show you one contract in the past that had an increase in rates over the first 3 or 4 years, where rates actually went up and growth potential increased. I'm going to show you renewal statements from another contract that's 4 years in going on 5, where the rates have not adjusted at all. And I'm going to show you one that just finished its surrender term with a 7 or 8% yield. You can't tell me that a contract purchased in 2017, 7-year index annuity that did over 8% in the final year, you can't tell me that's not a good deal. And then there's not growth potential in that. So rather than make this a super long episode to go through all of that, but you need to understand these things. You want the insurance company to be able to adjust rates because you don't want a company to go broke. Everybody worries about that too. What if they go bankrupt? Well, if they got to change their pricing because they've got serious financial headwinds, they're going to do that, and it's going to make sense. Maybe over the years, we'll get a little bit more transparency as to how that actually works. But that remains to be seen. Right now, we just talk about the fundamentals so we understand what we're going up against. And we've got good MIGA rates if you don't want the index annuity because, the insurance company is going to screw you. It's not going to happen. I haven't seen it happen. I can only do so much. Anyhow, again, thank you for joining me. Like, subscribe, or comment. Any of your favorite podcast platforms are on YouTube. Share it with your friends. We're getting a lot of followers. A lot of people are picking it up, and a lot of people are getting good information and exactly what they need. I appreciate you guys so much. Make an appointment if you want to talk about this specifically. Top right corner, any page on AnnuityStraightTalk.com. My name is Bryan Anderson. This is episode 130. I'll be back next week to show you proof of this concept in episode 131. Thanks so much. You guys have a great day.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.